the realization that we could actually experience hyperinflation on a global level.
Hello, and thanks for tuning in today. Silver and gold are well known as wealth preservation assets, but can they be more than that? Can the metals outperform other commodities when faced with hyperinflation? Oren, also known as the Silver Hermit, is joining me today. He is a market analyst and sound money advocate that is going to help us gain a better understanding of how gold and silver can behave during hyperinflation. Please keep in mind nothing in this video is financial advice. Oren, welcome back. It's always great to speak with you.
Good evening. Thanks for having me.
You bet it's great to have you on today. Gold and silver are widely considered to be wealth preservation assets. Let's say someone just sold an extra vehicle they had and they want to protect their profits from inflation. They might decide to convert that currency into silver or gold in order to protect their purchasing power. Oren, is it possible that someone can actually get rich from gold and silver as opposed to the metals only being a wealth preservation asset?
Yes. So we are often being told that gold and silver are only good for wealth preservation and not for wealth creation. And in normal times, that is probably true. But I argue that we're not living in normal times, that we're living in this crazy period in which we have a very high inflation, and I suppose that inflation is only going to continue because I don't see any real move towards governments restricting their spending, cutting their deficits, becoming more fiscally responsible. So I'm guessing that with all the money that has been printed over the past decade, with all those very very low interest rates, there's plenty of currency still circulating in the system. And there's still plenty of inflation ahead of us before it's going to be tamed. And I think I argue that specifically in this environment, this very unique environment, you can actually get wealthy out of holding gold and silver. And today we're going to try to make the case and explain why. Yes.
When new money is introduced into the system, does it end up getting evenly distributed among the population? And who typically ends up being the winners and losers in these situations?
I believe that there is a widespread misconception among mainstream economists. I argue that they don't really understand inflation. They think of the currency as water, as though if you open the tap and you start pouring water into the economy, then all the boats in the harbor are going to rise together. And by that, they mean that all the prices of all the goods and services, and also the wages, your wages, will rise together. And so they think of inflation as being neutral. There's an entire concept in mainstream economics. It's called money neutrality. I think it's complete hogwash. I think it's complete nonsense. I don't think money is neutral. I don't think the increase in the money supply is neutral because there are a few effects. First of all, uh, money takes time to propagate through the economy, and also it does not impact all the various sectors evenly. So I think that the way mainstream economists think about inflation is completely wrong. And this is why they behave very irresponsibly when it comes to the money supply, because they think it doesn't really matter. That if they generate some inflation, it's only going to, give a boost to the economy. It's going to be some sort of stimulant to the
Sure.
economy.
Uh-huh.
And yes, and what they don't realize is that they're causing damage to the public, and it's a long-term damage. And unfortunately, they're only going to discover that damage only once it's done.
That makes sense. And yeah, so they seem to think that if they just pump a bunch of money into the system, it's going to end up getting evenly distributed and everything's just going to work out okay. Um, but when you have people who are like on fixed wages and their wage doesn't increase, as opposed to a producer, like someone who's making a product who can increase the price, well, that person's going to be able to ride out that inflation a lot easier, where the wage earner is going to be dependent on their employer to increase their wages. And that's when these things can get a little sloppy, is what it seems like to me.
Yes, that's a good example. We call this the stickiness of wages.
Okay.
They tend to lag inflation because it's very difficult to convince your employer to give you a raise, which is according to the true rate of inflation. It usually lags behind, and this leads to the salaries of workers. They get eroded during an inflation. So that's one example why inflation doesn't impact all the sectors and all the prices evenly. Another very simple, very intuitive example is that, of course, when prices rise and your salary doesn't keep up with them, then you're going to start in okay, so you're going to focus on the essentials. Um, of course, buying food or you're paying your rent is more important than all sorts of luxuries. So I argue that in an inflationary environment, usually essentials are going to perform better than luxury goods, which are the first ones that we tend to cut down on, such as vacations or designer clothes. These are the first. The luxuries are the first ones we're going to cut down on.
That that makes sense. When prices start to rise due to inflation or hyperinflation, that means people need more money to buy the things that they need or want, as he was just describing. And a lot of the people that are going to get hit by that first are going to be the wage earners. What would you say is a better way to describe inflation when compared to like mainstream economists?
Yes, so looking for a better way to describe the impact of inflation on the economy, I am reminded of the work of Richard Cantillon. Now, Richard Cantillon was an Irish-French economist who lived during the 18th century. And what is interesting about his life is that he was involved with John Law and John Law's Mississippi Company. John Law was a Scottish economist who was active in France, and he is responsible for creating the famous Mississippi bubble, in which the shares of his company went into a huge bubble. And then, when the bubble burst, there was a huge economic crisis as a result. And Richard Cantillon learned the lessons from that bubble, and that inspired him to write his book. The name is in French. It's Essai sur la nature du commerce en général. This is the name, very complicated name for his book, but he's the first one who, I believe, argued that money is not neutral, that money does not impact all the sectors, all the different sectors of the economy evenly. And he tried to explain, we have the Cantillon effect. It's named after him, and most people think of that effect as simply meaning that the people who are closer to the source of the money get to enjoy it first. This is the way it is commonly described. that the people who are closest to the source of the money get to enjoy it first before it starts circulating and before its value depreciates. But I think it has even broader implications, which can be summed up as the fact that not all sectors of the economy are impacted the same way by inflation. And okay, so one of the way you can think of this. Now, let me get back to that image of the ships in the harbor, which as though rise together when the tide comes in and the water level rises.
Yes.
Now, according to the Cantillon effect, imagine that it isn't water in the harbor, that there,
Okay.
you have this kind of jelly, very thick jelly,
Okay.
which flows very slowly and not in an even way. And just imagine that the harbor is not filled with water, it's filled with this jelly which travels very slowly. And suddenly you understand how if you flood a certain area of the harbor with that jelly, then it's not all boats are going to rise together. The ones which are closest to the source of the jelly are going to rise first, and others, funny enough, may even sink lower. So I think that's another way of looking at it.
That's interesting. Yeah, I like the example.
If the jelly is the money supply, then usually boats rise when they are close to the money supply. But as we said, look at luxury items. When essentials rise, sometimes the price of luxury goods can actually fall. It's possible.
Sure, as the demand goes down, that they might need to decrease their profit margins. They don't want to have to close their doors. And then, people close to it, maybe some traders who made some big trades the day after a bunch of money was printed, they might be able to access a bunch of that wealth really quickly. And then, the fixed income people, 2 weeks later, when they're getting their paycheck, they have to go to the store and the prices have already gotten away from them. Everyone, when you get a chance, please check out the most recent video by the Silver Hermit. I'm going to leave a link to it in the description. It's very insightful. I think he came up with a really interesting way to describe how this unfolds using a king's carriage and its traveling party. Oren, could you please walk us through who might fall out of the traveling group first when inflation starts to pick up and who might speed ahead?
Yeah, so this is another metaphor I came up with. Again, in order to try and describe the effect of inflation on the economy more accurately. And I came up with this idea of a king's carriage traveling on a country road and escorted by his servants. And in this metaphor, the king's carriage, describes the rate of inflation. And the servants, some of them are walking by foot, and some of them are riding horses, and they surround him. The servants represent the prices of various goods and services. And you can imagine that those prices they tend to follow the rate of inflation, of course, because every manufacturer wants the prices of his goods to keep up with the rate of inflation in order to preserve his profit margin. But of course, some are leading by little, some are lagging by little. But I argue that when the carriage is moving slowly, then most of the servants have no trouble following it, keeping up with it, and as though they are moving as a group. And this is the normal situation that you and I are familiar with from times of moderate inflation, the Fed's mandate of having inflation around 2 to 4%. That means that most goods and services have no problem raising their prices by 2 to 4% a year, and it doesn't hurt the demand for those goods and services, and so they can keep up with, so to speak, the carriage.
I think it's a really great example. So once again, folks, please check out that video when you get a chance. During hyperinflation, the cost of necessities like food can drastically increase. Can gold and silver outperform other essential commodities during runaway inflation? And is it possible for the price of gold and silver to increase enough to noticeably increase your purchasing power, let's say during a hyperinflation event?
Yeah, well, let me get back to that metaphor. When you see inflation becoming hotter, that means that your carriage is starting to, ride faster. And then you have certain servants, some of the servants start having trouble following it. They start lagging behind. And some, the ones on horseback are able to race ahead. And you see what used to be a tight group, they start, there's distance. Suddenly there's distance between the servants. What I mean by that is during times of higher inflation, well, you have certain products which are able to keep up with the rate of inflation because these are, usually these are the essentials. You have to eat, you have to pay your rent, you don't want to become homeless, then you'll struggle to pay for those first. And usually these essentials are the ones who are able to keep up with the carriage of inflation. And then you have other products which lag behind, and the faster inflation goes, the more they lag behind. And this, of course, represents the fact that during times of inflation, the demand for certain products is going to drop, and as a result, their manufacturers are unable to raise prices according to the rate of inflation, and so their prices may rise, but not enough to keep up with inflation. And you see just the spread, the distance between the price, you see it growing. Now, the special thing about gold and silver, they are like the riders at the front of the carriage, because gold and silver, unlike other commodities, the demand for them can actually rise during times of inflation. As we all know, in normal times, in times of growth, in times of prosperity, most people don't want to hold gold and silver. Very few people stack gold and silver because their prices doesn't increase the same way as, for instance, stocks or cryptocurrencies. They're not as exciting during these times. But suddenly, when you have inflation, and since gold and silver are such good hedges against inflation, then suddenly you can see their price is surging, and I argue that they can surge even faster than the true rate of inflation. And that's the unique thing about them. Now, just imagine, well, we all know, their supply is limited, and they're very durable, and they're very compact, and you can hold them outside of the banking system. So fear is driving, fear of inflation, fear of financial instability is driving people into gold and silver. And so during times of high inflation, you can actually see the demand for gold and silver increasing. And as I said, their prices can surge above and beyond what the rate of inflation and certainly what other products may rise. And this is like the specific situation in which this outperformance of gold and silver can actually increase your purchasing power. Because although all prices during inflation, certainly during a hyperinflation, although all prices are rising, from the point of view of the riders at the front, from the point of view of the person who is holding gold and silver, all other prices are just lagging behind. And so it seems as though, in terms of gold and silver, these prices are falling, are actually falling.
That makes sense because they've outperformed them so much. When you go to use your gold and silver, you're actually going to be able to get more of those commodities, even though they've been increasing in price. Um, and so you can imagine places like Starbucks, people might start to not go for that expensive coffee and they'll just have their regular coffee at home. um, Maybe high-end clothing. They'll just decide, hey, you know what, this regular shirt keeps me warm. I'm just going to get a regular one for half the price. Gold and silver, of course, they last forever. They've been known as money forever. There's no counterparty risk, and it sounds like people will start piling into them. And I know there have been cases in hyperinflation situations where the currency was inflating so quickly that shop owners actually preferred to trade with people when possible. And so that could put you in a really strong position if you had some physical gold and silver and something like that came up. Oren, what example or examples can we look at historically to see just how much gold and silver can increase in value when facing hyperinflation?
Yes. So we actually have historical examples of this principle that we described in action. And the example I chose to bring today is of the hyperinflation in France during the French Revolution. Between 1790 and 1795, there was a hyperinflation in France. This was the result of an attempt by the revolutionary government at the time to introduce paper currency. And it's not as though they didn't know that paper currency can lead to inflation because we just mentioned the huge bubble that happened during the days of John Law and his Mississippi bubble, and that happened in France less than 100 years earlier. So they had that historic precedent, and yet they decided that they will try to issue paper currency. It was called the assignat, and they as though claimed that it would be backed with what? With the lands that they confiscated during the revolution from the nobility and from the church.
Oh,
So they had
interesting.
all the, yeah, they had all those, that real estate. And they argued, oh, that paper money is going to be backed by that real estate. But that's, of course, that's a ridiculous notion because in order to back a currency, it needs to be convertible on demand at your local bank against that asset which is backing it. And of course, how can you convert paper currency into land, into real estate at your local bank? It means nothing. Like if I have what? If I have a note, I'm going to go to the bank and they're just going to give me like a piece of earth, like you know,
You're
it's
right. Yeah, that
ridiculous.
doesn't work at all.
Yes, so you can't really back it against land. Perhaps if there was a way really to redeem the currency against, actual hectares, acres of farmland, and perhaps I can imagine it working, for as instead of business contracts, maybe for large businessmen it could work, but not as the currency of for everyday commerce for everyday people. It simply doesn't work, and almost immediately the value of those assignats started dropping. And every time it's very interesting. There's a small book which is called Fiat Money Inflation in France. It was written by a professor called Andrew Dixon White, an American. And he wrote it in the beginning of the 20th century. He wrote it as a cautionary tale to his students against issuing paper currency. And it's even kind of ironic that not long after that, the Federal Reserve was established and the United States itself started its journey towards paper currency. So they did not heed those warnings. But the book describes how the revolutionary government, every time that they said, okay, we're going to only issue a certain amount of that currency and not more than that. The supply is going to be limited. And every time they ran out of money, they said, okay, we're going to expand that supply, but just by a little and just a little more and just a little more and just a little more. And they continued issuing it more and more and more until it collapsed. This is what happens every time. This is what happens with every government. They're not able to resist the temptation to issue more paper currency because it's not backed by anything and there is no restriction on the amount that in which it can be printed. So this is an excellent example of the way prices can rise dramatically during hyperinflation and the collapse of a currency, and especially the way you see the difference between certain items and other items. So I'm going to just read you a list of prices, not the actual prices, just the degree to which they rose during that period between 1790 and 1795. So the price of eggs went up 20-fold. Okay, that's
Dang.
not 20%, that's 20-fold,
So so for easy numbers, well, $1 to $20.
something like that, of course. And coal went up 28-fold, shoes went up 40-fold, oats went up 55-fold, cabbage went up 68-fold, sugar went up 69-fold,
Yikes.
flour went up 112-fold.
Oh my
Now, note,
gosh.
yeah, notice this one because they needed flour to make bread. It was like this, the staple food. They had to buy the flour, and so it kept up with inflation better than shoes, for instance, because you can always walk another year in your old shoes.
Sure.
You don't you're not forced to buy new shoes until they completely disintegrate, right? And so the demand for shoes can fall while the demand for flour and sugar is, pretty much constant. So flour went up 112-fold and eventually wood went up 125-fold. Now, I'm not sure why wood outperformed other staple foods. Maybe because they needed it for,
For
as
heating?
yeah, for heating. Perhaps it was needed for heating, and perhaps in France, you have bitter winters, and they needed that wood for heating, perhaps. But then you see that gold and silver outperform all other commodities. And back then, of course, gold and silver didn't have an official price because they were still considered as money, but we can check exchange rates of currencies and coins before and after the revolution. So we can see that the price of silver actually went up 250-fold, and the
Wow.
price of gold went up 288-fold.
That's amazing. So far outperformed even the necessities.
Yes.
So
Because you
that
can, of course, you can cut down on the amount of food that you're eating, but okay, you have to eat, right? But
right.
when it comes to gold and silver, there's no boundary on their price. It's not as though you can say or you should say, oh, the price of gold is rising tremendously, so I'm not going to buy any gold because, it's too expensive right now. Well, it could be true. It's true in regards to jewelry. People didn't buy a lot of jewelry back then. But you need gold and silver in order to preserve your savings.
Right.
So, okay, so the fact that its price is rising, it's as though it's not an incentive to buy less of it. On the contrary, it's an incentive to buy more of it because you need to preserve your savings.
Right, you need to have it around. You know that the currency is losing value so quick. Companies are repricing stuff on a daily basis, or maybe even in the middle of the day they're redoing their prices. So you need it to preserve your purchasing power.
Yes. And one of the questions I asked is why did eggs rise the least? Why did their price rose only 20-fold? And
I
I'm
mean,
guessing that this is because, in normal times, it's easier for you to get eggs from, the farmer who specializes, who has the chicken pen. But everyone can theoretically raise a few chickens in their backyard, right?
right. And there was
So
probably even more people who were living in a rural environment in that time where they had the space for a chicken coop.
yes,
Less
so
people living in apartments and stuff like that.
Yes, so certainly in rural areas, it's rather easy to set up a chicken coop. So if you see the price of eggs rising tremendously, then you can raise a few chickens and have your own eggs. And this way, I'm guessing the demand for eggs dropped the most because it was easier to raise those chickens on your own and get your own eggs.
That makes sense. I think that's a good guess.
Yes, but it's probably more difficult, certainly for people in the city, to grow wheat. You need
Right.
the space, you need the land, you need the know-how, you need the fertilizer,
Right, absolutely.
and this
And
is why flour kept up relatively well with inflation.
and then I think trees could kind of fall into that category too, because you figure if you only have so much land, it takes a long time to grow trees back. You might chop down one or two and go, you know what? This isn't going to be sustainable. We're going to have to keep buying wood, or we're 12 more trees, we won't have it cut down and we won't have any trees left on our property.
Yes, I think that's a good explanation. But as we said, gold and silver kept up or even surpassed the rate of inflation. And for those who had gold and silver it wasn't a pleasant thing to live through the French Revolution. A lot of heads got chopped off back then, right and left. But for those who did have some gold and silver, some physical gold and silver, they probably did better than their neighbors because just think about it. Compared to eggs, for instance, before and after the revolution, gold could buy you 14 times more eggs.
That's a pretty significant increase in purchasing power.
Yes. Now, I don't have any data regarding real estate. That's a little trickier. But I'm guessing that the same principle is also true regarding real estate. So those who had some gold coins probably could have bought some real estate during that period. It was probably, its value probably fell. Um, One of the reasons is that the state started confiscating land, as we described earlier. So the ownership of land must have been an uncertain thing.
Yeah, that would have
And
seemed risky if there was confiscation going on.
yes, but still, if you were able to acquire land and keep it, then probably that gold bought you a lot more land after or during the revolution than it did before.
Right, absolutely.
So in a way, owning gold and silver could potentially make you rich during those times.
That totally makes sense. I and it seems to me, especially if you're able to transition out of it at the right time, let's say the price of land did go down and you were able to convert some of your gold and silver when it was at its highest purchasing power level into some land, you could do really well. And who knows, maybe it could be something else, one of these other commodities.
Yes, I'm guessing that there was plenty of For instance, fine art you could buy for cheap. All sorts of luxury items, which at the time were not needed, but perhaps if you could keep them uh, after the revolution, if you lived through the revolution and later, you lived through better times, then perhaps their prices could return. And if you bought them for cheap, then it could actually have been a good bargain.
That makes a lot of sense. And that's interesting that they were saying the currency was backed by land, especially with the idea that a currency should be easily convertible to the underlying asset. And using land for that, that does seems kind of crazy to me. All the real estate transactions I've ever done have been lengthy. There's no way I would see it as being easily convertible. And then you're relying on someone wanting that specific piece of land. Whereas, with gold and silver, it's something that you can just take and just hand to somebody else. You brought it with you and talk about being easily convertible. It's a peer-to-peer transaction.
My guess is that back then, people were more aware that currency needs to be backed by something. There was this general knowledge or realization that currency can't be just unbacked. And so they had to make up something in order to give people faith in that currency. So they invented that scheme as though it is backed by land. But of course, as you can see, this was just this was just a lie. It wasn't really backed by anything. And what's amazing is today people even don't have that basic realization. They think that fiat currency is perfectly fine and you can keep money in the bank, dollars or euros, and people are not aware that they're constantly losing their value because the pace of the carriage of inflation was moving very slowly in recent years. So people got this illusion as though inflation is no big deal and you don't really have to care about it. And it's only in recent years that people started realizing how damaging and how destructive inflation can be on their personal finances. And I think people are still clinging to the hope that inflation is over, that inflation is behind us, that everything is going to be fine. But if we're going to get another bout of inflation, for instance, then I think people are really going to panic. I think the next wave of inflation, this is the time in which people, having learned how dangerous inflation can be, I think the next wave of inflation is what's going to send people into gold and silver. And I think this is exactly what we're seeing right now. Seeing how gold has performed in the past year.
Yeah, that's a good point. Gold is up a lot. I think a lot of people are starting to pay attention to it. The mainstream has even reported on it a few times. So a whole lot of people might start to pile in. And we did have that recession, back in 2008, and that's going to be fresh in a lot of people's minds. And if it looks like things are getting bad, I could see a lot of people piling into it. And of course, by 2011, gold and silver had moved up a lot, since the start of that recession in 2008. Um, And then just some other examples of hyperinflation. Um, in Germany in the 1920s, before the hyperinflation, the exchange rate to dollars was 4 marks for $1. Well, in 1923, believe it or not, the exchange rate for $1 to marks was 1 trillion marks. Prices were rising so fast that some of the employers were paying their employees multiple times per day, so they could kind of, try and run out and buy goods before there was any additional price increases. I read one account of a student who had bought a cup of coffee for 5,000 marks and then went to buy another cup of coffee just a short time later, hadn't even left the cafe, and the price had rose to 7,000 marks just during the duration of time that he was hanging out in the cafe. A lot of folks might have heard when Rafi Farber had reported on the hyperinflation in Weimar Germany, and a few others have reported on this as well. But they say that you could buy a house for 150 ounces of silver by the end of the hyperinflation in Weimar Germany. So that's just another example of how silver can potentially make you rich in a hyperinflation scenario. And then, like Oren had pointed out, with a painting, let's say you bought a nice painting and then you wait till the economy's good again. You could imagine doing the same thing with a house or a condo. Wait until the economy's good again, and then you could resell it and really do very well for yourself.
Now, I want to point out, two final points. Well, first of all, every example of hyperinflation that we've given has been regional, has been, on a national level.
Sure. Hmm.
And this time, if we do get a hyperinflation of the dollar, then of course the dollar is the global reserve currency. So this time we're talking about a global phenomenon. And
That's a good point.
yeah, this will probably be the first time in history that we're seeing hyperinflation on a global level. And that means that it's going to be so much bigger. And because, even in past instances of hyperinflation, there were other currencies, stable currencies that you can run to. Like, for instance, in Venezuela, or you could run to the dollar, or in Zimbabwe, they run to the euro, which relative to their local currencies, they were stable. They were relatively stable compared to their local currencies. But this time, there's not going to be anywhere to run to other than gold and silver. This is my belief, at least.
That's interesting. That's very insightful. And actually that's pretty scary because yeah, there won't be any place to run to. Um and
By
you
the way,
know,
this is exactly what got me interested in gold and silver in the first place. This realization that we're going towards a global hyperinflation. I said those words back in 2013, those exact words. And
interesting.
back then they seemed like a crazy, completely crazy notion of a deranged person.
Well, that doesn't seem deranged to me today.
And today suddenly they're slowly it's becoming mainstream. The realization that we could actually experience hyperinflation on a global level. And the last point that I have for all you silver stackers out there is that back then, during the French Revolution, the gold to silver ratio, it was close to the historical ratio of 1 to 15, 1 to 16, something like that. So it's not a surprise that gold outperformed silver back then because silver wasn't so undervalued. Back then, the ratio between the two metals was more or less the same as it is as they exist in the ground. And so gold outperforms silver because it is more compact, it is easier to keep, to hide, and to transport over great distances. This is why back then gold somewhat outperformed silver. But nowadays, of course, the gold to silver ratio is in the 90 region. So silver is so undervalued compared to gold. And if during this hyperinflation we actually see a mean reversion and return to the historical ratio, then silver can greatly outperform gold, and you can see absolutely crazy returns on it.
That would be exciting. Yeah, and talk about um getting rich from the metals. I mean, the interesting thing too about the idea of a global recession is the global population is so high right now. They think that if we're talking investment grade silver, so not jewelry, um, not stuff that's already built into heavy industrial equipment or anything like that, but the investment grade silver that's out there and that's available, so coins, rounds, bullion. Um, if you were to take it and evenly distribute it among all the humans, it would only be 0.38 ounces per person, about the amount of weight of silver that's in one US half dollar. So if a bunch of people started piling into it as well, I mean, gosh, yeah, it could be really crazy. The returns might be something that's hard for me to comprehend right now.
I'm guessing that it's going to be whatever gold rises times 10.
Yeah, it wouldn't surprise me if you're right. It could be really volatile to the upside.
Yes, because after the gold to silver ratio has been so high for so long, if it needs to mean revert, then it's probably going to overshoot. And from a ratio of 90 to 1, we could hit a ratio of 9 to 1 or 8 to 1. Who knows? It's possible for a while.
Sure. Well, and if it is coming out of the ground at a rate of 1 to 7 today, maybe it could even get down to 1 to 7.
Who knows? It's perfectly possible. The thing is, we don't know for sure what's going to happen. We're just asking people to keep an open mind and to to be open to that possibility and also prepare themselves for that possibility. I'm not telling anyone to go all in into gold or silver. I've never told anyone to do that. And I'm not trying to create FOMO or anything like that. I just want people to keep an open mind and to have some exposure to physical silver because in the, wild case that our predictions come true, then it can really help them. That can be really be a game changer for them.
Right, absolutely. Just sitting on your silver that you have right now, hanging on to it, because looking at these historic examples, it really can do very well in these situations. And it's highly concerning that we could be looking at a deep recession in the near future. And, I'll put the pop-up video for this video. It, I, a conversation that I previously had with Oren about a recession, and hearing his thoughts on that, and three major indicators why we might be going into one.
Yes,
Um,
there's an expression that you Americans use that I really like, life-altering gains. Life-altering gains. I really like that expression. And although we've seen all sorts of crypto assets doing that, but if there was ever something which is like fundamentally sound, which is grounded in fundamentals and grounded in historical lessons that we have in front of us, that's silver, physical silver. And yes, I'm going to say that I do think that there's the potential for some life-altering gains to be made in the silver space, and just by sitting on some physical silver. I can't guarantee that, of course. So don't go and run and convert everything you have to gold and silver. But I certainly believe that the potential is there.
Heck yeah, well, it makes sense. I'm sure that stackers will be glad that they have it if that day ever comes. Of course, I don't think anyone wants to see a terrible recession, but it's got to be one of the best ways you could potentially prepare yourself for this. A lot of folks think that silver might be the most undervalued asset on the planet right now. So when this thing takes off, it could really be something else. Thanks everyone for watching today. Please hit the like button and subscribe to the channel for more content like this, and so you don't miss our next interview. Everyone, please check out the Silver Hermit on X and YouTube. Links to his accounts are going to be in the description. Oren, thank you so much for sharing your knowledge and insights with us today. And as always, I look forward to our next collaboration.
Thank you. Thank you for having me. I always enjoy our conversations. And till next time.